Welcome to Talk Tickers. Biogen just dropped a huge third quarter, absolutely crushing earnings estimates. But here's the twist. The stock actually fell about 5% right at the open. So, in this explainer, we're going to break down exactly why that good news looked bad at first and what it really means for investors going forward.
Okay, so right out of the gate, the headline number was just a massive beat on earnings per share. I mean, Wall Street was looking for $3.88, and Biogen comes in and posts $4.81. That is a gigantic upside surprise.
And just to put that into perspective for you, we're not talking about a few pennies here. Biogen beat the consensus number by almost a full dollar per share. That's a really powerful signal about the company's core profitability right now. Revenue also came in really strong, beating expectations and growing 3% over last year. But the real story on this slide, the thing you really want to pay attention to, is that second bar. Revenue from their brand new launch products just skyrocketed by 67%. Now that is exactly the kind of momentum you want to see from a company that's in the middle of a big transition. So this brings us to the big puzzle of the quarter, right? With such a strong beat on revenue and on earnings, why on earth did the stock open down about 5%? It just doesn't seem to add up. Let's solve this.
To figure this out, we've got to get inside the numbers. Let's start by breaking down Biogen's performance and see where all this growth is actually coming from.
So if you look at the revenue mix, you can see their old multiple sclerosis franchise is still the big cash cow, bringing in over $1 billion. But, and this is so important, the new products like Skyclarys and the Alzheimer's drug Leqembi, well, they're now bringing in really significant nine-figure revenues every single quarter. These are becoming major pillars for the whole business. And that's the key point right there. That stable, predictable cash flow from the MS business isn't just some legacy thing. No, it's the financial engine that's paying for the R&D, the marketing, basically the entire rollout of these new high-growth drugs. Think of it as the bridge to Biogen's future. And speaking of fuel for the fire, the company generated a staggering $1.2 billion in free cash flow just this quarter. This is the company's war chest. It gives them incredible flexibility to invest in new drugs, make smart acquisitions, whatever they need to do. Okay, now we get to the real heart of it, the story that management told on their earnings call. This is where we find the answer to why the stock dipped. It's a classic story of trading a little bit of near-term pain for a lot of long-term gain. And here it is. This is the slide that spooked everybody. Despite that huge Q3 beat, Biogen actually cut its full-year earnings guidance by about $1 per share. Now, on the surface, that looks like a really negative signal about the business, and that's exactly what caused that initial sell-off. But management was super clear about how to frame this. They kept stressing this was not a demand shock, which means it's not because their sales are getting weaker. No, they called it a deliberate investment choice. They are actively choosing to spend more money right now to build a stronger company for the future. And here's that strategy, laid out plain and simple. Biogen is going to use all that cash to go out and buy one or maybe even two new promising drugs by the end of the year. The accounting for those deals is going to show up as a big R&D expense in the fourth quarter, and that's the direct reason for the guidance cut. So you see, they're basically taking the money they over-earned this quarter and plowing it right back into their future. So, after that initial knee-jerk sell-off, how did investors process this whole story? Let's take a look at how the market actually digested this news as the trading day went on. This timeline really tells the whole story, doesn't it? The stock opens down big on that headline guidance cut. But then, as analysts and investors actually listened to the call and started to understand the strategy, the stock staged a full recovery. It actually ended the day up over 1%, a complete 180 in sentiment. And listen, this didn't happen on some quiet day. Trading volume was about 1.6 times the normal daily average. That tells you a lot of money was changing hands, and that the buyers who understood the long-term story ultimately won out. It was a very high conviction turnaround. So the big takeaway here is pretty clear. After the initial confusion, the market looked right past the noisy short-term accounting and actually rewarded the company for making a smart, forward-looking investment. They bought into the long-term growth story. All right, that brings us to our final section, the next call. So, with all that behind us, what should you be watching for now? Let's break down the specific things that could really move the stock over the next couple of quarters. First, we're obviously going to be looking for the announcement of those 1 or 2 deals they promised. Second, a huge one will be the adoption of Leqembi's new at-home version that's a subcutaneous injection, under the skin, which could really speed up its launch. Third, we just need to see more clean execution on their current launches. And finally, the overall mood for the biotech sector has been getting better, and that could give them a nice tailwind. So, what's our official call here at Talk Tickers? Well, we expect Q4 results to come in right in line with that new, lower guidance, with all the focus really being on any acquisition news. We think the stock will probably be kind of range-bound until one of those big catalysts we talked about actually happens. And for us, the single biggest variable, the thing that could really change the story, is how fast that new version of Leqembi gets adopted. And that leads us to our final rating, market perform. Look, the company is running a very clear and logical strategy, trading that short-term certainty for long-term growth. The core business is solid, but the story from here really depends on them successfully closing those deals and executing on these big product launches. We'll be watching those catalysts very closely for any reason to re-rate the stock. This is not financial advice.